there is a gentleman in Poland. His name is Tomasz Biernacki. He's a true capital allocator. He started his business more than 20 years ago. It was a small grocery store in a small town in Poland. And the whole strategy till this day is opening grocery stores in towns where there are less than 30 to 50,000 people. And this strategy, it's been so successful that over the past 20 years, he's been opened more than 2,500 grocery stores around Poland. He has made himself a billionaire, and he has made his investors billionaires, because there's a one private equity fund who acquired 49% of the business. Tomasz still owns 51%, the majority till this day. And when it comes to compound annual growth rate, I mean, most people, most investors, there are very few in this beautiful world who are able to compound 30% plus over their career. But what Dino Polska, this is the name of the grocery store, the brand in Poland, what they've been able to do is, since 2010, in 2010 they had 111 stores in Poland. And when you look today, in 2014, they have more than 2,500 stores around Poland. And this is a public company now. It's trading 7-8 billion US dollars. It's the market cap. And the gentleman, Tomasz Biernacki, his net worth 4 billion something. And it's an interesting story. This is not an interview, first of all. Secondly, it's a holding company research. How I come up with those researches is I'm a curious guy. Whenever I buy something, whenever I see something, in this case, the Dino Polska, this was the brand I saw when I had a flight through Poland, and I was there, and I went to a grocery store, and this was Dino Polska. And I started looking what they're doing, how they're doing. And whenever I found myself in a focused position, like for more than 10-15 minutes reading something, it must be very interesting, because every day I see various articles, topics, things. I try to read quite a lot, but whenever I become extremely focused, I'm like, okay, this is something I need to read. I need to get into this. And Dino Polska's story was that. And I decided to go into the rabbit hole. I did my research. I was reading about this, listening to different interviews. I hope to maybe one day get Tomasz to the podcast. We'll see. But today's episode, it's all research, and this is done based on the information I found on internet. I even translated some of the things from Polish to English, and I wrote down 15 takeaways as a lessons, because if you want to buy a business, grow a business, buy different traditional businesses, what we can say is Dino Polska today, it's pretty much like a holding company of grocery stores. And each grocery store, I was when doing a research, each grocery store doing at least 1.5 million in revenue. Obviously, some do more, but average is something 1.8 million, and it's generating like a store level operating margin of around 8%. And these metrics translate into strong returns on invested capital, ranging from 20% to 30% at varying maturity stages. And Dino Polska, it has become this standout player in the Polish grocery market, showcasing this like a unique model with impressive growth rates. Again, founded in 1999 by Tomasz Biernacki in a small town in Poland. And the Dino today, it has grown from single store into a chain that now operates close to 2,500 stores across Poland and serving primarily small towns and rural areas. What's extremely fascinating. This rapid expansion has been achieved entirely organically with no acquisitions to date. And remember, I said to you about compound annual growth rate. When people try to do this with capital, it's very hard to achieve 30%. But these guys have been doing this when it comes to opening stores. So 2010, they had 111 stores. And today, 2024, they have more than 2,500 stores around Poland. And if I'm correct, like 16,000 employees. And financially, Dino is a powerhouse within a low margin industry. As the fourth quarter of 2024 starting, the company generates around 6.5 billion in annual revenue, and again with the market cap around 7 or 8 billion. And Dino's same-store sales growth has consistently outpaced food inflation, indicating strong customer loyalty and effective store economics. At the store level, Dino achieves gross margins about 25%, on par with some of the best in the industry and much higher than the industry average in Poland. The company stores reach maturity in about 3 years, achieving average annual revenue per mature store of approximately 1.8 million. And as I said, the store level operating margin of around 8%, which then translates into a strong return on invested capital ranging from 20 to 30% at varying maturity stages. And what sets them apart from the larger players on those markets is their capital structure, and they're extremely disciplined, because despite its rapid growth, the company has leveraged only moderate debt, with net debt to EBITDA sitting at a conservative 1.1 times. So in this case, a ratio of 1.1 times suggests that the company's net debt is slightly more than 1 year's worth of its operating earnings before interest and taxes. Remarkably, Dino has funded nearly all expansion through reinvested earnings, with around 96% of cash from operations directed back into the business since 2014. 96%. When you look at some different traditional businesses, I've met with tons of folks who own and they built those businesses for 20 plus years. Today, they do EBITDA between 1 to some 5 million per year. When it comes to EBITDA, these guys tend to take more dividends. What I mean, like oftentimes it's 50 or 60% of the free cash flow they generate per year. They take half of it and they pay that in dividends. So Dino's case, they've been 96% from from the earnings they've been investing back into the business. These guys are into this for a long term, and that's probably the secret and the secret sauce behind this extreme growth. And who's responsible of this mindset? It's the gentleman Tomasz. He, as I said, retains a 51% stake, and he's extremely committed about the company's future, and giving him 51% obviously gives him this significant influence over its strategic decisions of what exactly they are doing on day-to-day basis. Next, when it comes to real estate, Dino's approach to real estate ownership is another critical factor in its financial profile. Owning approximately 95% of its store locations has enabled Dino to eliminate rental costs, which in Poland average about 3% of revenue for retailers, providing a considerable cost advantage. The average Dino store requires about 650,000 US dollars in initial investment, including land and construction costs, which are managed by a separate construction company owned by Tomasz Biernacki. It's very interesting strategy, and people listening from US, from London, from around the world, 650,000 US dollars for a building and the land to set up a store. It seems like nothing, But coming back to their strategy, they're focusing on those very small towns. Remember, 30,000 to 50,000 people or less. The land is cheap, and this has been, again, the secret of expanding so quickly. And this upfront cost is recouped in roughly 9 years, after which ownership becomes substantially more economical than leasing. When looking around on my own market here in Northern Europe, and I did my own research, the local players, I mean, 75% of their stores they're not owning the buildings. This again makes Thomas's strategy of building Dino so interesting. They pretty much own all the real estate, and they've been able to reinvesting those profits back into those buildings in the new small cities. And that has been the secret of this growth again. What's even more special is when you look around the market itself, the competition, the international giants like Carrefour or Tesco, they have been forced to either exit or scale down operations in Poland. By focusing on the underserved population in small towns and offering a comprehensive assortment of low priced staples, Dino fills a unique niche. The company serves 80% of Poland's population who live outside urban areas, allowing it to reach customers directly where they are. I've been driving around Poland many times, or actually cross Poland from Germany all the way through Poland to all the way to Lithuania. Poland, the roads very good. Now, as they are a part of European Union, it has changed a lot over the past 10, 15 years. And when because there is one main highway which goes all the way through Poland, and now it's very easy, very convenient. But if you go back to Poland 10, 15 years ago, there were small roads, and whenever you were driving, after 10, 15, 20 kilometers, there was a small town. It, like, my father is a truck driver. I used to be with him when I was younger, like a small kid, 10 years old, 7, 8 years old. Every summer, I was driving with him all the way from Northern Europe to Spain, Italy, and Poland was a mess because Poland had so many small towns, even I would even call them villages, one by one. And this has been the strategy for Dino. He opens a store in each of those small towns, small villages, where there's not too many people, and that has been so rewarding for them. And as of today, Dino's market share in Poland's 60 million US dollars grocery market stands at about 5%. But in its most mature market, it's a name of the Polish city called Kratsin, Dino commands a 45% share. This suggests substantial growth potential within Poland alone, with an addressable market opportunity estimated at 11 to 20 billion US dollars in annual sales if Dino's footprint could cover the entire country. With international expansion in neighboring countries like the Czech Republic, Slovakia, and Lithuania as a potential future avenue, Dino's growth story is far from over. And with robust financials, a carefully designed operating model, and deep community ties, Dino Polska exemplifies how a focused, efficient approach can transform a small town grocer to a national giant. So from here, it gets even more interesting because out of all the research, I decided to write down like 15 takeaways from Dino Polska's approach, starting from the focus on niche markets. By actually choosing small towns rather than those larger urban areas, Dino Polska avoided direct competition with larger established chains, the international brands, and this strategy allowed them to cultivate loyalty among rural customers who value proximity, affordability, and convenience, ultimately securing a unique and defensible market position. And so many lessons for you building a business as well is that you can learn from this approach by identifying underserved markets where you can pretty much grow without intense pressure of high competition. And if you look around yourself, you look around the competitors of your current business, you can always do some type of add-on acquisitions where you see an opportunity of you can what I've seen recently, and one of the deals we are looking at the moment, there is a potentially 2 or 3 add-on acquisitions could be done on top of the main business. And what that does is you can pretty much sell to the same customer just a different product which they're already using and buying that from a different supplier. But if you buy the 2 or 3 suppliers, you have a pricing power, you have this branding, a bit of moat, and it's going to be much better margins. And by this way, you can create more opportunity for yourself, and you eliminate the competition. And same way what Dino Polska was doing by not wanting to compete with the folks who have this insane balance sheets, the large international brands, by avoiding how to avoid the competition with them. Go to a market where these guys are not interested in operating. Second takeaway, customer-centric model. Dino's success comes from a deep understanding of its customers' needs, especially their sensitivity to price and desire for accessibility. Because when you go to those small towns, oftentimes there are not too many like manufacturing buildings, manufacturing businesses, because these are all around big cities. And when you look at those small towns, they're often small businesses, oftentimes older people, a lot of farmers. And these people are obviously more price sensitive than people who work in a busy capital of Poland, Warsaw, for example. It's totally different, and the pricing there, pricing expectations obviously a lot lower. And that's what Dino did. They really understood from day one what are the customer needs, and by consistently offering essentials at the lowest prices nearby, Dino has made itself indispensable to rural communities. And this model highlights the value of building a business around a specific customer profile and meeting their most fundamental needs better than anyone else. Another takeaway, standardized store format. Dino's strict adherence to standardized store layout not only ensures a uniform shopping experience, but also simplifies training, reduces operational complexity, and makes expansion scalable. I was able to, as I got curious, I visited 2 stores and they're identical, pretty much like almost the same. And these guys have been just copy pasting those stores all around Poland. One store and more than 2,000 versions of this one store. And imagine if they own this same construction company which builds those buildings. Imagine how cheaply they acquire the materials if they do a bulk order. It's such a smart model. Another one, vertical integration. What Dino does extremely smart move is they own and manage their own meat processing facilities. And by doing this, they reduce its reliance on external suppliers, and they pretty much control one of the highest margin product categories in Polish grocery. And by owning and manufacturing your own meat, you pretty much control the quality and you minimize supply disruptions and achieve higher gross margin due to a fewer intermediaries. Number 5, we already talked about this. Own the real estate. Dino's choice to own rather lease store locations grants it greater control over its long-term costs and eliminates rent volatility, a significant factor in a retail expenses. Yes, all this requires higher upfront capital, a lot higher. It's a huge investment. But when you look at the number, 650,000 per location, land plus the building, it's not that high. And it's only doable because they're focusing on those small towns. This is a perfect example of the owners thinking about long term. Number 6, you don't see many ads about Dino Polska. Their ad revenue, ad expense, it's minimal. And Dino capitalizes on its strategic placement and reputation for low prices, negating the need for large marketing budgets. Instead of expensive campaigns, Dino builds awareness by being conveniently located, and maintaining a value proposition that naturally attracts budget-conscious shoppers. This here is another example how a business like Dino, and there are probably many other you can learn from this, is you don't need to use traditional advertising if your product and your market position are strong enough to drive organic growth. Number 7, efficient store economics. They're able to run those stores so profitably that Dino stores reach maturity in 3 years and begin generating strong revenue and profit margins, showing that upfront investment can yield solid returns if the model is sound. This quick path to profitability, combined with manageable operating costs, ensures each new store adds to the company's bottom line. Number 8, founders' vision and control. There is a reason why Tomasz didn't want to sell majority of the business. He probably had a bigger plans and he probably needed a bit of growth equity to do that. So till this day, he has been able to retain majority ownership. And by doing this, Dino has benefited from consistent visionary leadership aligned with long-term value creations. Tomasz's deep involvement helps maintain the company's founding principles, which are fundamental to its success. Lesson for me, and probably yourself as well, whenever growing a business, you want to stay in control. Number 9, predictable expansion. Dino's ability to assess store potential based on local population density demonstrates a powerful level of predictability and risk management. Tomasz and its management team, they know very well how each store will likely perform before it even opens, and this all reduces uncertainty and aids in strategic planning. Number 10, simplicity in offering. If you think about this, who are the customers who are visiting Dino Polska on day-to-day basis? These are simple people living in small towns. Their expectations are not crazy high. Obviously, the quality is there, but they don't expect some type of luxury food, or if you can even say that, some expensive things like fancy food. They don't expect that. These are simple people with practical spending habits, and all this reduces the risk of unsold high-cost specialty products for Dino. And this model not only simplifies inventory management, but also keeps operations cost-effective. Number 11, data-driven decisions. What Dino does on week-to-week basis is adjustments to price match local discounters show a commitment to staying competitive without sacrificing profitability. This approach strengthens customer loyalty and protects market share by ensuring Dino remains the most affordable option. You can be sure there are other smaller stores in those small towns, small cities as well, and they're doing the same thing. And they try to provide even lower prices. But what Dino does, they do the same. And what eventually happens, like what happens with the larger players, Dino can do it so much cheaper because they don't pay that high rent. They probably, after some years, they own the real estate. So imagine competing with a store like this, with a brand like this. It's very hard when you're playing the long game. Number 12, controlled growth financing. Dino has successfully avoided diluting ownership by funding expansion through reinvested earnings and moderate debt, highlighting disciplined capital management. By focusing on self-financed growth, Dino maintains control over its strategy and minimizing shareholder risk. Number 13, this is a big one, strong margins in a low-margin industry. Despite operating in the low-margin grocery industry, Dino's approach, leveraging real estate ownership, vertical integration, and low advertising costs, enables it to achieve higher than average margins. And this exemplifies how operational efficiency and strategic choices can yield superior returns even in challenging industries. And this is the case, and this is the reason why I wanted to do this research about this Dino Polska, because performing so well in this highly competitive industry with usually very low margins, they've been able to do that extremely successfully. And by doing that so successfully, there is a lot of potential to expand internationally, because while Dino is focused on Poland, The same operational model could apply in neighboring countries with similar economic and demographic characteristics, offering a future growth avenue. Take Slovakia, take Czech Republic, take Lithuania. How many small towns there? Hundreds, even thousand. I was looking at the statistics in Poland. When you look at there are 1,030 cities and towns which have less than 50,000 people. And if you open like 4, 5, 6 stores in each of those cities, you have a lot of business. And this is what Dino could do in Lithuania. This is what they can do in Czech Republic. This is what they can do in Slovakia. And going from there, soon in 10, 15 years, these guys could end up having 10,000 stores around Central Europe. All this success they've had today and what they have in the future, it comes down to this long-term vision with reinvestment mindset. And Dino's focus on reinvesting earnings rather than paying dividends emphasizes a commitment to scaling the business sustainably. This reinvestment mindset, very rare in European grocery space, highlights Dino's long-term approach to compounding value. Because for companies in growth phases, prioritizing reinvestment can often yield more significant long-term return than short-term payouts. And this is what many founders, shareholders, companies end up doing. They pay dividends. They pay it too often. The dividends are too large. They contain a too high percentage of the yearly earnings. And that way, imagine competing with the guys from Dino who reinvest 96% of earnings. Eventually, you're gonna lose. And this is it. This was I even call it like a rich roadmap for entrepreneurs and investors aiming to build durable, scalable businesses in competitive markets. And when I found the Dino story, Tomasz, the founder, I hope to have him. I hope to have him on the HoldCo Builders podcast one day. But till then, I hope you enjoyed the research. So many lessons. If you're first time in here and if you're a continuous listener, make sure you follow, make sure you subscribed, because I try to do it on week to week basis. Either I'm posting a research or I'm posting an interview with a person who's building holding company, buying businesses, investing those earnings back into their business by buying more businesses, stories like this. So again, thanks a lot for listening and see you in the next episode.